Markets fall as economic fears surface in bond markets. So it started on Friday with the Moody's downgrade. Moody's ratings assesses the creditworthiness of companies, governments, and securities to provide credit ratings. On Friday evening, Moody's lowered the US's debt rating to AA1 from AAA. The former AAA rating was the highest creditworthy level, while the downgraded AA1 rating is still high but lowered a notch to represent concern with the US's rising debt. So Monday opened lower, but a strong retail investor buy the dip wave helped markets to recover. However, debt markets finished higher. Interest on the 30-year Treasury bond topped 5% briefly on Monday and ended Wednesday above the mark. An increase in rates typically means investors see more risk and therefore require more interest to buy. While the debt market continued to rise, the S&P has fallen 2% since Monday. So why the delayed reaction? Well, likely a few things. First, the macro uncertainty continues. We've been talking a lot about this over the past few months with tariffs and consumer sentiment faltering. While we're off the normal quarterly cycle, it's still the heart of earnings right now for retail. Retail earnings and outlooks have been mostly weak, warning of softening consumer demand and vague price uncertainty. Second, the US's new proposed spending package may add trillions to the US debt over the next decade. In general, for everyone, not just governments, holding more debt makes repayment more risky. And finally, weak demand for US debt. The US Treasury saw weak demand in its recent 20-year bond auction. This means there currently is weak interest for US debt, so in order to sell, higher interest rates are needed. This also means the cost to fund the US government will be more expensive as well, with higher interest payments. So why does this impact stocks? Well, true, stocks or equities are considered risky assets, while debt or bonds are typically more stable. However, uncertainty in one market can disrupt other markets. In addition, higher returns on more stable assets can create less demand for riskier assets. The debt markets are signaling concern with macro uncertainty, even if the optimistic equity investors have largely shrugged it off. We'll continue to watch bonds as another signal for the macro.